The government doesn't miss their goals. Everyone thinks the government's stupid. The government's playing 3D chess and everyone else is playing checkers.
Right.
They know exactly what they're doing. Have you ever walked to a buddy and said, you got to go talk to my accountant. You won't believe how much I paid in taxes.
Right.
I paid so much tax this year. You got to go talk to that
But
guy.
I'm going to pay less in 30 years.
Yeah, they don't. That's not the accountant's job.
So we know we want to avoid IRMAA. We know we want to avoid future income taxes as much as possible. People just look at the pretty stuff in the graphs. They don't read the prospectus. They don't read the details. And the devil is
in the details. How you make the money is dependent on how you save the money. Everyone is different. Do not follow the same advice that your parents and grandparents and friends and cousins and uncles follow. Ask questions. Figure out what works best for you.
Welcome to the Unlocking Senior Resources podcast by Leave the Key. I'm Larry Wagner, and I've spent 30 years working with seniors where I was a certified senior advisor, and the last 15 years in the home buying industry as a certified senior transition specialist, where I specialize in dealing with seniors going through a transition in their lives. This podcast is for seniors, those with seniors they love, and people who work in the senior community. In each episode, we bring on a guest who works to improve the lives of seniors. This podcast is your key to unlocking senior resources. Welcome. Today we're here with Jim Capuano from, I'm going to read this, there's a lot. He is the president of Integrity Life Brokerage, that is the founding firm of the Great American Retirement Myth. Did I get that right?
That's correct.
So I wrote it right and I read it right. Perfect. That's more than I've ever had to say before. So
it's a good start.
It's a good start. Well, welcome. Thank you for coming.
Thank you for having me.
We chatted a little bit before the cameras are rolling, and my background is in the financial world, and that's what you do. So I'm extra interested today, and I think it's going to be a great podcast. There's so much information here that people have to take away, so have your pencils ready. This is a really worthwhile bit of information, and it's turning people's ideas upside down about how to handle their
preconceptions.
Their preconceptions. Is it a preconception if you're already retired?
Not really. It's more for the planning.
Correct.
But we call it deprogramming people from the path that's been chosen for them.
That makes sense. That's true, because we've been taught a way to do things, and you're saying that way is wrong, and I've agreed with you for a long time, and I didn't follow that path. So, first of all, let's talk, how did you get to the insurance business, and then how did you get to the Great American Retirement Myth?
Sure. So I graduated college in 2007, and the only places that were hiring when I got out of college were financial firms. And now I didn't do anything regarding finance in college. I was a sports management major and a marketing major.
Okay.
But they were who's hiring. So I went to all the big insurance firms, did my interviews, and I ended up choosing MetLife.
Right.
So I did 5 years as a financial advisor. 3.5 of which I didn't know what I was doing, but I had a card that said I was a financial advisor, so people would listen to me when it came to their retirement.
Right.
I was just good enough at that job to ruin my life.
Ruin your life?
Yeah, to ruin my life, meaning that I was well above my minimums, but I was well below the conference level. So I was in that pay no mind section of the insurance advisors. I got an offer to leave in 2012 to go for a company that does wholesale insurance, a local company. They were more on the benefit side, but they were looking to grow their life division. And it was funny because even though I worked for an insurance company, I was mainly focused on annuities and managed money.
Right.
But I knew life insurance pretty well, so I took the leap. I said, I got to get out of here. This is just quicksand. I got to go. So I went into wholesaling. I worked there from 2012 to 2019, and in 2019, I was established enough that I left and started my own wholesale company, my own life brokerage. And my job there was to help advisors all over the country sell insurance products to their clients. And through those meetings and through that network of advisors, I started to see these trends about things that didn't really make a whole lot of sense, but they were set in their ways and they wouldn't really listen to my suggestions in certain areas. And then I met this guy who talked about these things called IRMAA, which I didn't know about, and how Social Security works and Medicare works. And I was like, I don't really care about that stuff.
And how old are you now?
I was at the time probably 38, 39.
Okay, 38 years old, and they're talking about IRMAA.
Talking about IRMAA.
For the first time, and IRMAA, for those who don't know, is a surcharge on your Medicare
income-related monthly adjustment amount. It's how much more you have to pay for your mandatory Medicare expense in
Right,
retirement.
the mandatory Medicare,
Mandatory.
correct.
It's the only mandatory expense you have in retirement. The more you make, the more you have to pay. And I didn't really, has nothing to do with what I do until I realized that the things that I'm selling don't impact it. And that was what I needed to hear to get my message out cleaner and more effective to the financial community. And as I spoke to financial advisors all over the country about this, I realized how few of them actually cared.
I mentioned to you that I learned about IRMAA when I was probably in my 50s as a financial advisor. When a client said he made $20 too much, and now his monthly premium went up by $100, whatever it was. I don't remember that at the time. This goes back, 20 years almost. And he said, "What do we do about it?" And you're addressing it before it ever happens.
We're trying to get people to never hit it because it's 100% avoidable.
Yes.
You could make $10 million a year and not pay a penny into IRMAA. It all depends on how you make the money.
Right.
And how you make the money is dependent on how you save the money.
Okay.
And that's what we call the Great American Retirement Myth, is you're being told a lie because it's just the way the industry works. It's cookie cutter. Everyone's retirement's the same.
So I'm 68. Is it too late for a 68-year-old to subscribe?
No.
No. Okay.
No. So what we always say there's 3 levels of people when it comes to IRMAA. There's the retiree.
Right.
You're already seeing the impact of it. There's less that you can do, but there are always things you can do. Then there's the pre-retiree, the people that are in their 50s that have the bulk of their money saved. Now they're planning on retiring soon. Now they have to start worrying about their distribution. That's repositioning assets. That could be looking at Roth conversions. That could be looking at spending down your qualified assets earlier. That could look like many different things, looking into a tax efficient annuity. Then there's the income earners, your people maybe 35 or 40 up until you're the pre-retiree that are just getting established, are living a comfortable life, and now are starting to fund their retirement. Right. And they're most likely putting in a 401k or a 403b, an IRA, and then everything left over they're throwing into non-qualified.
Yep.
The problem is all of those count towards IRMAA. And IRMAA is getting worse and worse and worse because Medicare is getting worse and worse and worse.
Worse meaning they're lowering the thresholds or they're raising the premium?
They're raising the premium,
Right.
and they're not raising the thresholds as much as they're supposed to.
Okay. They should be raising at least with the rate of inflation, but...
It should be going up by the CPIW
Right.
or the CPIU, and it's not. If you look at it, I think last year we had a 10% increase in New York, just under 10% increase in Medicare premium. It went from around $190 to like $202, give or take a few bucks. But the first IRMAA bracket went from $212,000 to $214,000. It only went up by $2,000.
Wow, $2,000. So, how much do you say? 200?
$212,000 as a joint filing couple to $214,000.
That's like 0.5%.
It's nothing.
Right, it's nothing. So if inflation's at 3%, it went up 1/6. I'm making up the 3%. It went up at 1/6 of that rate.
So what they need, if you look at what the government is telling us, and I'll give the government credit here, they're not hiding this.
Right.
They're telling everyone, but the average person's not looking at it.
Oh, if they did, they wouldn't understand it.
They wouldn't understand it. And the financial advisors are just not communicating it to the clients. So if you're looking at this data and you're saying, hey, I have a choice with my money that I can save it. Do I want to defer taxes now on this dollar, let that dollar grow for the next 20 to 30 years, so now it's $30 or $50, and pay tax on it then, where it's going to affect my mandatory Medicare premium, or should I just pay tax on it now? If you give that option to people, 99% of them are going to pay tax on it now, especially because we're in historically low tax rates.
I've been preaching from the rooftops on my phone for probably 2 or 3 years. I had one of the open tabs, because I had like 80 or 100 open tabs. Let's not go there. But anyway, I just had to do something on my phone. They all got wiped out. So I have to start all over again, collecting more open tabs. But I had the historical tax rate, the federal tax rate, from the time it started, I think in 1920, whatever, until current. And I then hold like a card or something showing how many years we've been above where we are to how many years we've been below. We've been as high as 90-some-odd% in the Jimmy Carter. Not for us older people, not ancient history. And he was that was my first presidential election, so to me that was significant. And between him and and now, and then under Reagan, where it dropped so much further. And you look at the economy, so we're under where we are today, very few years, and only by very little.
Very little.
And we're over by many more years and many, many percentage
Yes.
points. I'm talking about tens and tens of percentage points being 3, 4, or 5% lower.
Yeah.
So if we're at, let's say, 39%, whatever the current high bracket is today.
The high bracket is historically low.
Right. It's
But the
effective
average
rate.
effective rate
Yeah.
is almost the lowest we've ever seen it.
Right. It's people don't get it.
No.
If you're ever going to convert to Roth, this is
Right now.
generic advice. Generic advice.
Right
I'm
now.
not looking at your financial stuff, but now is the time. And last year I converted quite a bit
Yeah.
for that reason. So,
Yeah.
but we're going to talk about Roth conversion. That's a big deal.
It's a
Yeah.
big tool, and the financial community does do it, but a lot of them aren't doing it the right way. And when I say the right way, it's how they're coming up with the amount of money to do the conversion for.
Yep.
They're either just taking the gains,
Right.
or they're saying, well, we're only going to convert so we don't put you into the next tax
Right.
bracket, which seems like it's a smart idea because who wants to pay more taxes? But the fact is, don't worry about the next bracket now because the rate in that bracket is probably still going to be lower than the rate in the bracket when you take it out in retirement.
Man, oh man, preaching to the choir.
Yeah.
Listen to him. He's smart. He agrees with me. Yeah. There you go. So with that said, also people have to pay attention. I don't want to be in the next bracket. One bracket goes up like 10%. The next bracket goes up 2%.
Yeah.
There's like 10% and I'm simplifying. Don't worry about going up the 20 to 24% bracket, even if you're worrying about bracket. But worry about going from 34 maybe to 24 to 34. But you're saying maybe not even that.
We saw it with mortgage rates.
Right.
Everyone refinanced between
Yes.
2009
Right.
and 2019.
Yes.
Because rates were at
Historic.
historic lows.
Yeah.
There's only one place they can go when they're in historic lows.
Right.
And it's up.
Yep.
And now you see everybody scrambling.
Yep.
It's the same thing with tax rates, except it's the opposite. When they're low, they're good in mortgage rates.
Right.
And when they go up, they're bad.
Right.
Whereas everyone doesn't want to pay taxes ever. So
Right.
there's no good tax rate.
Right.
No one's happy with the tax rate.
Right.
But when you're at historic lows, they're only going to go up.
Right.
So why are you deferring money?
Yep.
And the answer is, accountants get paid to do a job. Their job is to get you to pay as little tax as you can right now. An accountant is not your retirement planner.
I never thought of it that way. Pays a little tax now.
Now, that's their
Not
job.
as little tax. Not as little tax over your lifetime. It's little taxes you can pay now.
Think about it this way. Everyone in our business works on referrals.
Yep.
Have you ever walked to a buddy and said, you got to go talk to my accountant. You won't believe how much I paid in taxes. I paid so much tax this year. You got to go talk to that
But
guy.
I'm going to pay less in 30 years.
Yeah, they don't. That's not the accountant's job.
Right,
That
right.
should be the
But they
financial
don't say
advisor's
that.
job. They don't say that.
They don't say that. If the
They
accountant-
say you got to talk to my guy. I barely paid anything in tax this year.
How do you get referrals if you're telling pay a lot of taxes?
Yeah, I get in a lot of fights.
You get in a lot of fights.
I say a lot of buzzwords that really anger people in the financial industry and accountants.
Yes. You said you speak in front of other groups, other professionals.
I talk, I do all the time. I speak in front of rooms of maybe 60, 70, 80, 100 advisors. And I mean, some of them are slinging tomatoes at me.
Yeah.
At the end, I'll get about 20% say that makes perfect sense. And just like me, the first time I heard this, the light bulb went off. I said, that's the information I've been looking for.
So
That's the tie-in to what I'm doing. So I'll get about 20%. If it's a good group, maybe 30%.
Right.
Where they'll come up and they say, this is what I've been looking for. This makes total sense.
So far, I agree with what you said. Tax rates are only going up from here for the most part. And now's the time to do conversions. I agree with that. Watch out. You have to prepare for IRMAA. I agree with that. I'm curious where the rest of this great American retirement myth goes, because I want to see if I agree with everything.
Sure.
And let's see let's see how much we can have common ground.
So we started about around IRMAA. IRMAA
Yes.
was the centerpiece of the great American retirement myth.
So just to put things in perspective, what is the basic Medicare rate today, and the high IRMAA rate today?
It's 202.
Right.
And the top one goes up right now, I think, to 750.
Or 750. I thought it was 800. 750. Okay,
It's just base Part B. Then you have to add on your Part D, and Part D also counts towards IRMAA.
Oh, okay. But let's just do the one part. So you're saying just round numbers, 2 to 750, just round numbers.
So
you're talking
for the same
about
coverage,
$550 a month. That's $6,000 a year.
times 2 if you're married.
If you're married, right? That's $12,000 difference, money coming out of your pocket every year if you screw up because you're making too much money. So
think about this. This is an example I always give. If
Yeah.
you're a 60-year-old couple in
Yeah.
New York right now,
that's interesting. You can
you
go
want
with
to
this.
you want to retire at 67,
Right.
and you're planning to live to 90. Now I know nobody can plan to
Right.
live to a certain age, but we're going to use 90 as a
My
barometer.
father will just celebrate his 98th birthday.
God bless.
Yeah. So. Yep.
That's what we're seeing too. Longevity
Yes.
is a problem in this country.
Yep.
Not for the people, for the
Yep.
country.
Yep.
Problem.
It is running out of money.
We're running out of money.
Yeah.
Because they're still paying it.
Yeah.
And that's why they're getting more aggressive with Medicare and IRMAA, because the more they pay, the less Social Security actually hits the pocket of people.
Right.
Those are just tools to keep Social Security alive. That's all they are.
Yep.
So a 60-year-old couple going to retire at 67, live to 90. If they want to be fully insured, meaning that they're taking a supplemental G plan, now they have no copays, no out-of-pockets.
Right.
Anything can happen. They never have to spend another penny. It's going to cost them nearly $1 million in retirement.
Wow.
So I do this in my
Wow.
seminar. I show them the numbers.
Right.
I show them how we come up with it because it's easy. The government's already telling us what they're inflating at, 7.24%.
Really?
For at least the next 9 years.
7%.
7.24, at least 7.24. It went up by 9%, a little over 9% last year.
So they talk about I'm sorry to go off on a tangent. It seems like the insurance companies, the medical industry is corrupt because the cost of medical care and long-term care and everything health-related is growing at a rate much higher than inflation. But so is the cost of
I
the
would
government's
agree
doing
with
the same.
that. But if you look at the cost of Medicare,
Right.
it's drastically lower than it should be.
Okay.
Because it's insuring our oldest population.
Yep.
And if you compare the rate, so it's going to be around it. So you pay 25%, that's your base.
Right.
So the overall rate is around $800, maybe $850 a month
Right.
for a single. If you look at what a single person is paying for their health insurance as an employer, what a 40-year-old is paying, it's not much less. Now, who's using more medical services? The 80-year-old on Medicare
Okay,
or the 40-year-old?
Right.
So comparatively, Medicare is very, very low. And I have a theory as to why it's so low, but they're raising it to just try to keep up so they're not losing so much money.
That's like the long-term care insurance industry.
Long-
They sold those policy premiums at way too low.
Way too low. Now we sell them. They say, well, I got a 15% increase this year. I said, yeah, but you've been paying 40% too low for the last 20.
Well, I got to tell you, I have a policy with John Hancock, and I don't feel that way as a consumer of the policy,
Yeah.
even though I'm the one who sold it to me.
Yeah.
Right?
Yeah, yeah.
So I yell at myself all the time. So
So you're getting crushed on raises.
I'm getting crushed.
Yeah,
Absolutely.
absolutely. But if you look at it and
Yeah.
you say, well, I've been underpaying this,
Right.
I've saved money, that money went to other things.
Yeah.
So I've probably made out in the deal. But as a consumer, you don't feel that.
You
Same
don't.
way with Medicare. All I'm seeing is my price go up.
Right. But I interrupt you.
No, it's fine. So when I tell people that you're going to pay $1 million in retirement, I always ask this very important question. Please raise your hand if you have a financial advisor you work with that has prepared you for $1 million expense in retirement.
And I'll bet all the hands go
Oh,
up.
everyone's waving at me. People look around, and this is when the husbands start to get mad.
Yeah.
Like, I never
husbands.
liked that guy. I knew that guy was no good. But it's an important thing. So I discuss this with the financial advisors, and they're just like, it just means they're doing well. It's not what it means. It means that they planned poorly.
Right. You can still do well and not have that exposure.
Yeah.
That's the key. They have the best of both worlds.
Yeah. We knew this client. Well, and I didn't personally. My partner knew this client. He sold his business for over $70 million.
You could retire on that.
He could retire. He was doing fine.
He could pay IRMAA.
Yeah. He had over $100 million with one of the big wirehouses on Wall Street. And he got an IRMAA bill. Nothing. I mean, the guy doesn't care about his Social Security. He
Right,
doesn't care
yes.
about the $250 extra he's paying in IRMAA, but he got
right.
it. And he called up his advisor. He said, what's this bill? And he said, oh, that means you made too much money and you have to pay more to Medicare. And he said, why didn't you ever tell me about this? He said, because it's nothing. It doesn't mean anything. He said, it means something to me. 2 days later, he transferred all his money out.
Really?
People just want to be told. They just want to be informed. Let them make the decision
Right.
as to what's important, what's not. It's not the financial advisor's job to decide it's obsolete. It doesn't mean anything.
Right. This extra $500 and $1,000 a
Yeah,
month.
you have plenty of money. You don't tell me how much money I have.
Right.
You work for me. I don't work for you. You don't make the decisions. I make the decisions.
Oh, that's a kick in the patootie.
Yeah.
Holy cow. I don't think I would have reacted that way personally if I had $70 million, but But
Yeah, I mean, it might have been a little drastic. I'm sure there was more to the
Maybe.
problem.
That's what I'm
That could
wondering.
have been that could have just been what broke the horse's back. But
that, I imagine that's a pretty harsh thing for something. I don't want to say minor, because minor is a relative term, but seemingly minor.
minor to him.
Right.
I talk to people all the time. We spoke to a woman. She called us up about 2 months ago. She retired, just went on to Medicare, just went on to Social Security at 67, has no idea why she's getting this IRMAA bill, because she's making very, very little money. She's got a small pension, her Social Security check, and a few $1,000s a month from her IRA. I said, you're right, you shouldn't be anywhere near IRMAA. But for the last 5 years, her financial advisor was telling her to do Roth conversions.
Oh. Yep.
For no reason whatsoever. He just took the gains from the qualified money and did a Roth conversion. On paper, seems like a good idea. I'm a big fan of Roth conversions. Never looked at IRMAA. Never asked her if she's going to care. Now she's in IRMAA. She'll never get out of. I'm sorry, she's older than that. She's 70.
Right.
So now she's going to be in IRMAA until she's 72 because it's a 2-year look back.
Yep.
At 73, her RMDs kick in, and she's got a lot of qualified money. She'll never get out of it. She's in IRMAA for the rest of her life, and it's only going to get worse.
So would it pay for her to do massive conversions now, spend the next years in IRMAA, and not be...
We looked at it for her to say, hey, we're going to just do it all in the next 4 years.
Right.
We're going to do really large conversions over the next 4 years. And we have proprietary software that'll show us the status quo versus all of our alternatives. For her, it didn't really make a difference because she would have been in such a high bracket for the next 6 years. She would have had to live to like 95 to break even.
This Roth conversion, which I'm fighting with myself, it's way more complicated, like you said. It's not just the next tax bracket.
Not the next tax
I've seen
bracket.
some calculators online now through some of the big companies that make it so much more complicated. There's so much more nuance that I'm not even sure nuance is the right word, but details I never would have thought of.
Yeah.
And I come from this universe.
Yeah. A lot of it depends on your age. If you're and when you're going to retire. If you're 63 and you're going to retire at 65, be careful. If you're 63 and going to retire at 70, much more reasonable.
What happens if you're 68 and you never plan on retiring?
Yeah, that's the other thing. Yeah. Well, just do it before your RMDs kick in.
Yeah, it's kind of, I have 5 years or 4 years. I think I'm 72. I think I'm the last 72-year-old. So I think my wife's 73, I think, for her.
So right now it's 73, and they're moving it to 75 soon.
It depends on your birthday.
Depends on your birthday.
Right.
So you might be 70 and a half.
No, I'm not 70. I think I'm 72. They moved to 72, and then, because I thought I was 72, and then my wife's 73. Is that possible?
Yeah, it could. Yeah,
I think
because
that's
you
what
might
it is.
have where you were when they moved the
We're 2
bracket,
years
but they're
apart.
going to move
Yeah.
it to 75, and everyone thinks that the government's doing us a favor. The government's just building up their savings because half that money's theirs.
Right.
And they're saying, hey, we're gonna let this grow. If you look at the concentration of wealth in this country, it's mostly with the baby boomers.
Oh, absolutely.
When I say mostly, I don't mean like most people have it there. I mean, if you look at the money, most of it is there. It's all theirs.
Right.
Now, if you look, it's very interesting number crunching that somebody did. By 2034, it's the year that the last of the baby boomers hit RMD.
Oh, that's interesting.
They're projected to have, I believe, 36 trillion saved.
I was going to say it's
qualified
trillions.
money.
I don't know how many.
36 trillion. Does that number sound familiar?
No.
It's the national debt.
Yeah, I was going to say, it just occurred to me. Yeah.
Yeah, it's the national debt.
So
is that a coincidence that they're moving the RMD back to when the baby boomers' qualified accounts are going to hit what our national debt is?
if they can collect all of it, they can pay for it all at one time.
Well, they're going to collect most of it.
The reality is it's going to take them the next 25 years to collect it.
Yeah, but it's just going to pay down the debt.
Yeah.
They're just going to, and as it's growing, they're going to pay it down more and more and more because what are we going to do with tax rates? Most likely between now and then, raise them up.
Definitely. Right. For those who are listening, I'm holding my thumb up.
Yeah.
Right. The yes, that without a doubt. The I have a million things to go over with you, but I'm going to let you keep going. So now we're talking about preparing for IRMAA is one of the issues. That's important. You're a fan of Roth conversions for the right people at the right time.
Correct. They should be considered by everybody.
Okay.
consider them. A lot of people won't consider them because they don't want to pay the tax bill.
Right.
You have no choice. You have to pay the tax bill.
Right. It's the old Fram commercial. I may be predating you. The oil commercial. They show a guy changing the oil filter. Say you can pay me now. You see a guy getting an engine overhaul, or you can pay me later.
That's exactly right.
Pay me $20, $50, whatever for an oil, $100 for an oil change, or an engine, redo the engine, rebuild it. So same thing. Pay tax at 24%, whatever today, or pay tax at 44% in the future.
Yeah.
I'm making up
when
numbers.
you're older,
right,
and most vulnerable, and have no ability to earn extra income.
Interesting. And you have less control because many people are living on a pension, and Social Security, everything's fixed. When now I'm self-employed, so my income is very malleable, if you will. I can put income into next year. I can take income for this. I can do a lot of things. A lot of people can't do that. But sometimes you can semi-retire. You can work fewer hours as you get older. But once you're retired, everything's fixed. There's not much you can do.
What you've saved is now your salary.
Right.
You're in complete control of how much money you take out.
But you do have control. Yes, how much you take out, but you have control of where your assets are, and that's a big part.
Yeah.
But even then, if your investment assets, you control those. I'm saying your whole life, where you put them.
Sure. Yeah.
Right.
Well, you invest. And a big thing, the great American retirement myth, we don't tell people where to invest their money. We're not picking a stock for them and say, hey, don't invest in this sector, invest in that sector. We are more, so we talk about diversification.
Right.
And if I ask people, what do you think about diversification? The first thing they say is, it means my money's not all in one place. And it's extremely important.
I have CDs with 5 banks.
Yeah, exactly. I'm partly in large cap and partly in mid cap, and I have a few stocks and I have a few different products with a few different companies.
Yes.
I'm diversified. That's one type of diversification. If I ask somebody, that's always what they talk about.
Yes.
What nobody talks about is tax diversification.
I'm a big proponent of that. Also, where you're drawing your money from, and so on and so forth.
That's what our message is.
Okay.
Just diversify the tax code on the dollar. What you do with the dollar is entirely up to you and your advisor. You can invest it in anything you want. But there's fully taxed money, meaning ordinary income. There's capital gains. And then there's tax-free. You have to be in a little bit of all three of those, preferably just the last two.
Right.
Capital gains and tax-free.
People think capital gains, they think 20%. And that's not true. It could be as low as 0, depending on how much you earn, 15 or 20. And so everyone thinks, capital gains are 20%. But it's not as straightforward.
Everyone I talk to says, it's 15%. I said, it could
really?
go up. It could go up to 20.
Yeah, okay.
And they don't really think of that. And then I tell everyone, there's not a huge difference between capital gains tax and your effective tax rate. For a lot of people, your effective tax rate could actually be lower than capital gains.
That's true.
So,
That's true.
Don't think that just because you're in non-qualified assets, you've made great tax decisions.
Right. Also, let's say effective tax rate, for those, just to be clear, is the rate you're paying on your taxes relative to your overall income.
Correct.
Not your highest bracket. That's your marginal bracket. So if you make, I don't know where the brackets are, $100,000, that last $10,000 may be taxed at 24%, but your overall tax bracket may only be 16%. You may pay, so if you make $100,000, you may only pay $16,000 in taxes, which means your marginal tax rate is 16%. Your effective tax rate is 16%. But your marginal may have been 24.
Might have been 24.
Your maximum bracket. But the maximum's not relevant. It's what you paid. It's the 16,000.
It's just the average. It's a tier. You're paying all the way up. You're not just paying on the last dollar.
And that's what people think. Oh my God! If I make more money, I'm going to pay 24% from $1. No, you pay this.
But that's how capital gains works. You're paying whatever your capital gains tax is from the first dollar of gains.
That's true.
All the way up to the last dollar of gains. Yep. So.
And that's a cliff kind of thing. If you make $1 to put you in the next bracket, you pay that higher rate on everything. Right.
Yep. So we talk about, if you have the ability to contribute to a Roth, seriously consider contributing to a Roth. Too many people don't do it.
Yep.
Their accountants are telling them you need the deduction now.
Back to what you're saying.
Back to what I'm saying.
Save taxes.
When the tax changes came about with the first Trump administration and the deductions, it hurt certain parts of the country, but overall helped other parts of the country. Nobody cares about the country. They only care about themselves. So people in New York who lost the ability to write off the mortgage and other things, like, this is no good. We're getting killed on taxes. So people started contributing more and more to qualified plans. And I'm just telling you, you're just kicking the can down the road. You have to pay it. Pay it now at a low rate, or pay it then at most likely a higher rate. I spoke with a guy the other day, and he's putting almost $250,000 a year into a cash balance plan. And he
Explain
loves
what
it.
that is.
So a cash balance plan is a specific retirement account that the owner of a business can have. And you're allowed to put in way more than a normal 401k or 403b. But there are stipulations. It's basically a contract with the government where you have to put in a certain amount for a certain amount of time. Otherwise, you lose all the benefit. So people like it because you can defer a lot of money. And when you think about it, it sounds really, really good. And he said, somebody said I should talk to you. I have a cash balance plan that I opened 3 years ago.
Right.
And I went over this information with him. And he was like, well, I'm not going to do it anymore. I said, but you have to do it now. You've already made the deal with the devil. You have to pay for at least 2 more years.
Yeah.
And he said, well, then what do I do? I said, then you have to start looking at Roth conversions.
Right.
So you got to hope tax rates don't go up in the next 2 years. Otherwise, you're going to take it on the chin. You're going to lose more money than you saved.
Right.
But you're going to save more in this instance than if you waited till retirement.
Pay the price today.
Yeah.
That's basically what you're saying.
Pay the price today. Yeah. Give yourself more time to recoup it.
Yep.
Don't pay the price when you're retired, not working, can't earn income, and have to pay Medicare.
Yep.
Because the average American, not high income earners, the average American, Social Security is the basis of their retirement.
Yeah.
I always say, if you have a good financial advisor, they're going to say, you're going to make around X amount in Social Security. This is how much you need to live. We have to fill in the gaps. You're going to take out 4% a year, the old Monte Carlo simulation, which drives me crazy. But we're going to take out 4% a year. So we have to fill in this gap. This is how much money you need. If you have a really good financial advisor, they'll actually sit there and log in and find out how much your Social Security is going to be, so they get a more accurate assessment of what you have to do. Very few financial advisors deduct Medicare from that number.
Oh, that's interesting. That's a big deal, as we
It's
talked about.
a big deal because now you're talking about, even if you're at the base number, $202. We said it's going up by 7 points per person. So it's $400, around $400 a month. Part D is probably another $150, so you're at $550 a month. Those numbers are increasing by 7.24%. If anyone knows what the rule of 72 is, if you divide your return by 72, that's how many years it takes to double. It works the same way with inflation. So it's 7.24%. Every 10 years, Medicare is going to double. So you go from 500 to 1,000.
Right, in 10 years.
1,000 to 2,000 in 20 years. In 30 years, you go from 2,000 to 4,000. So if you're
way more than the rate of inflation,
now,
and way more than the increase in your income when you're retired.
Way more.
Yeah.
So if you're 40 years old now, by 70, you're looking at $4,000 a month. That's $48,000. When you're doing your retirement plan and you look at your Social Security check, what financial advisor is telling you that $48,000 is coming off the top? Mandatory.
Right.
And the craziest part is you pay tax on that money. You pay tax on your gross Social Security, not the amount that hits your account.
And so Medicare is not a deductible expense.
Not a deductible expense.
That's interesting. I didn't realize that. I don't even look at my taxes. I have no patience for that.
It's because right now it's not a huge number. It's $2,400 a month now. Nobody really $2,400 a year. No one really cares.
Right.
But when it's going to be $4,000 a month, people are going to care.
Yeah.
And they're not preparing for it. So what I say is, what you think you're going to need in retirement is going to be more.
Right.
So I call it the gerbil wheel. So if you look at our website, our Great American Retirement Myth, it's a guy on a gerbil wheel, because that's what I say. Once you get into retirement, you need money.
Right.
Social Security is the basis of your income. You don't realize that you're going to get less than you thought you were going to get. So you take more money out of your retirement accounts. Your retirement accounts are taxable. So your tax rate goes up, your IRMAA goes up, your Medicare expense goes up, your Social Security comes down. What you've taken out isn't enough. So you have to take out more. You take out more, it happens again. You need more money. You just keep going like this.
Yes.
So when people say you're going to take out 4% in retirement, of course, everyone assumes that the money's going to go up.
Right.
It's going to go up by 10, so I'll have a net gain of 6, so I can keep taking out 4%. But what happens when it goes down? Do you take out 4% of what you have now?
Right.
Or do you take out what 4% was of the higher number? Most people take out what 4% was of the higher number. So now it could be 6%, it could be 6.5%. When you do that, you're depleting your funds further.
Yep.
You're paying more tax. So people say like, oh, I'm going to take out 4%. It's not going to work that way. You're never going to take out, you're going to take out what you need to live. You have no idea what that percentage is going to be.
Well, your goal is to take out the 4%. According to what advisors say, your goal is to take out 4%. I've been hearing a lot about the 4% rule. Is that actually accurate or not accurate?
So they call it the Monte Carlo simulation after the casino town. And they did all these scenarios of all these different allocations, 50-50 stocks and bonds, 80-20, 60-40. Right. And what they found was at a 60-40, and you do a 4%
60-40 stocks
to bonds. At 4% withdrawal, you have around a 90% chance of not dying broke.
Right. I think it was if you live to 95. But if now you live to 96, that chance goes down.
It changes.
Yes.
And then the more aggressive you get, the lower your odds go in certain areas, the higher they go in others.
Right.
So it's a good rule of thumb, but too many people depend on it. If somebody's 82 years old and they need X amount of money, they're not going to say, well, I could only take out the 4%. No, you're going to take out what you need to survive because that's what you've worked your whole life for. We are big proponents of it's easier if a portion of that money doesn't have to go to the government.
Oh, right. What percentage of your income is going to the government?
Yeah, because we have no idea what percentage is going to go to them in the future. We know how much goes to them right now.
Correct.
So do you want to take that variable off the table? Stop deferring taxes.
So we know we want to avoid IRMAA. We know we want to avoid future income taxes as much as possible. We're not going to avoid all income tax because, I mean, again, we have Social Security income that we want, and that you don't want to defer. I don't want to say don't want to defer. That you want, and that's taxable. Nothing you can do about that unless you have other losses to offset that income. That's a whole
Social Security income is also banded. You pay 50% of your Social Security in income tax. Not 50% of your Social Security is subject to income tax.
Right.
Unless you make too much money.
Correct.
Then 85% of it is.
Hi, I'm Larry.
And I'm Ben. We're the father and son team of Leave the Key Home Buyers, and we want to buy your house.
We specialize in working with seniors who are transitioning out of their homes, and we understand what you were going through.
So if you're considering selling your home and would like an alternative to the traditional overwhelming process, reach out and see how we can help.
Do you have an outdated home?
No need to update anything.
Have a home that needs repairs?
Don't bother with repairs.
Don't want to take everything with you?
Leave whatever you want behind.
Dreading the headaches that come with agents?
Sell your home without paying a commission.
Dreading prying neighbors, attending open houses, and passing judgment on your home?
No need for public showings.
When you sell to us, you'll have all the certainty of closing on your timeline, not someone else's, and there's absolutely no pressure.
Visit leavethekey.com or call us today for a no-obligation offer at 631-388-7771 if you want to sell your home today.
I'm shocked, I gotta tell you. I worked with retirees who retired on $60,000 pensions. Because I know what their Social Security looked like all those years. Then I went to the calculator and looked at my Social Security with my wife. It's huge. Yes. It's a six-figure number for the two of us. Yes. I was very, very surprised. I could go somewhere else in this country, not here on Long Island, and retire
comfortably
on my Social Security alone. That blew my mind. But if I lived somewhere else, I wouldn't have made as much money as I made here in New York. So I couldn't have retired on Social Security so right away.
So I had a young couple. I was doing the report for them. And in the report, we have a link where it goes directly to the Social Security calculator. And you put in your date of birth, how much money you're earning, when you're planning on retiring. And it gives you an assessment of, hey, if you stay within the normal parameters of the income and it increases with time, in the future, this is how much Social Security you're going to get. And their number was like $15,000 a month combined. They were young. They were in their late 30s, early 40s. Right. They're like, there's no way that's real.
Right. So I agree. It's no way it's real. They're not going to get it.
We're talking about 25 years from now.
Right.
$15,000 may seem like a lot of money now, but it's not then.
Right. Back to that rule of 72.
Yeah, and you're not going to get that money. That's just what you're going to pay tax on.
Right.
You're going to end up getting $7,000 a month. But a financial advisor is going to look at that and say, $15,000, you're only going to need $25,000 to live, so we only have to solve for $10,000 a month.
Right.
Until you have a $7,000 shortfall because they didn't factor in Medicare and IRMAA.
I believe that Social Security is going to become a means-tested program. That's what I think is going to happen. I think if you make too much money, you're not going to qualify anymore.
But that's what IRMAA is.
Yeah, that's true.
That's exactly what IRMAA is.
But I think if I were 30 years younger, I think I would get no Social Security. That's my guess. That I would income out of it, and that's what I think. It's the only way to keep it alive. That the wealthy people don't need even the upper middle class people. I don't want to use the word wealthy. I don't know what to define that either of these terms, but it depends where you live, I guess. But that they just don't have enough money to give the people who really don't need it the money, and I don't think they're ever going to fix that.
So, if you think about this, there's 3 legs to this stool.
Yeah.
There's IRMAA,
Yeah.
Medicare, and taxes.
IRMAA, Medicare, okay.
All 3 of those
Yeah.
determine Social Security.
Right.
So I'm going to get a number make $5,000. That's
Right.
what my Social Security base number is.
Right.
My tax rate, my Medicare expense, and my IRMAA depend how much of that $5,000 actually goes into my pocket. Mm-hmm. What are 3 things the government controls?
Right. Well, they
control tax rates,
right?
They control Medicare,
Right.
and they control the IRMAA brackets.
Correct.
They already know exactly how many people they need in IRMAA. They've told us this information. Mm-hmm. By 2034, they need 1/3 of the population in IRMAA, and it's going to have to generate around $68 billion a year.
They need 1/3 of the population IRMAA, so they can absolutely do that. Just change the
They
thresholds.
they pull the levers to make sure
Right.
1/3 is in. So when we go through what our projected brackets are, people say, how would you know what the brackets are going to be in 2035? I said, we don't know what the brackets are going to be.
Right.
But based on today's numbers at a normal inflation, this is what they're going to need. So the government doesn't miss their goals. Everyone thinks the government's stupid. The government's playing 3D chess and everyone else is playing checkers. They
Right.
know exactly what they're doing. And this is another line that we always have. They have the largest sales force in the country making sure they hit their goals.
Salesforce?
Yeah.
The IRS?
No.
Oh, who?
The financial industry.
Oh, that's interesting.
They're like Kaiser Soze from Usual Suspects.
Oh.
Everyone works for them and they have no idea.
And that's very interesting. So we're all feeding into them, I know, unwittingly.
Yeah, because, hey, contribute to your 401k,
Yeah.
max it out if you can,
Right.
get your company match because that
Yeah,
3% is free money. Whatever else you can put into an IRA, then the rest put into non-qualified. What do they do for tax-free? They put it in muni bonds. That's everyone's
That's
tax-free play.
Yep.
Triple tax-free.
Yep.
Problem is there's 4 taxes. IRMAA is just another progressive tax.
Right.
Muni bonds are not
Exempt.
exempt from IRMAA. Everything you do, you listen to your financial advisor about. Everything they're telling you to do is raising your mandatory expense in retirement, reducing your Social Security, raising your Medicare costs, and saving the government.
That's funny. Financial industry is working on behalf of the government,
And they don't even know it.
and they don't even know it. I've never heard that before.
I can't take credit for that. That's
Okay.
my partner told me that years ago, and I was like, that makes perfect sense.
That's fascinating. Spending 30 years there. I was dealing with retirees who already had money in their retirement. So I was promoting Roth conversions. At a time, advisors weren't promoting Roth conversions at all.
Nope.
Because they just took money out of their pocket and put it in the government's
That's
pocket.
correct.
And
Now
they
they're
wanted it.
managing a lower asset.
Correct. Exactly.
They don't want to manage a lower asset. That means they lose money.
Right. I thought I was doing the right thing, so I always did it. But I lived my life that way. But I saw my friends say, you're crazy. You're giving up money. I say, but it's the right thing to do, but you're giving up money.
Yeah.
I said, but where's the question?
Yes, exactly.
But that's the way they think.
That's called the fiduciary responsibility. You're
yes.
not, the money is supposed to be just there,
Right.
based on what you're doing correctly.
They were being fiduciary responsible for themselves.
That's correct. They were exactly right.
I keep kicking the camera. That's twice. Oh gosh, there's so much.
Yeah.
Okay, so how many legs are there, if that's the right word, to the great retirement, the great, what do you call it? The Great American Retirement Myth. How many subsets, chapters, whatever the word would be?
So we have we talk about taxes.
Correct.
The craziness of deferring. Now, that's a new thing.
Yes.
If you look at people who were maxing out their 401k in the 90s, couldn't have worked out better for them. If you're retired now, taking your income from your 401k now, and you deferred taxes in the 90s, it worked out perfectly. It was exactly what it was supposed to be.
Just the rates are
but now
low
everything
now.
flipped.
Right, they were higher then than they are now.
Correct.
This is exactly what you wanted.
Exactly. And you're in a lower bracket, all that good stuff.
Yes.
Even though I think that's a myth too, that you're going to be in a lower bracket in retirement. You're never going to be in a lower bracket.
I say no matter how little you make, you're going to pay more in tax. I say the same thing.
But
I want to interrupt one second.
Yeah.
My daughter, the year before she started teaching, she's 33. She started teaching when she was 24. So when she was 23, I said, next year when you get your first job, put money in a 403B, max out the 403B. Then she gets her first job the next year, and I said, don't put any money in a 403B. Just forget the 403B and put it into a Roth.
That's right.
That's what I told. So in that 1 year, my mind shifted,
Yep.
and she has $0 in a 403B, and she just kept contributing to a Roth.
And the Roth, it's. I can't stress how important a Roth is now.
Yeah.
Now again, in 10 years, that might shift back to go to traditional.
Right.
The problem is,
if the rack-
industry hasn't shifted. The industry is still doing traditional.
Yep.
Because it's what's easy. It's a cookie cutter. It's set. You don't have to convince you don't have to convince a new hire to contribute to their 401k.
Right.
The advisor who's managing the 401k comes in, they answer 7 questions on a questionnaire, say, you're a moderate to aggressive, this one, this one, this one, this one, and this one. Give me my 1%.
Yep.
And they walk out the door.
Yep.
That's all they do. It's easy for them. Now, should they do less in the Roth than they might in the traditional, just so their net out of pocket doesn't go down? Yeah, I would say that's probably a pretty good idea, because you don't get the deduction.
Correct.
So instead of maxing it out, put $19,000 into your Roth.
Right.
Your take-home pay hasn't changed a bit. You'll have less in your account, but it's fully tax-free.
Yeah.
If the tax rates go up, you've made out in the deal. So that's one leg of it. We talk about IRMAA, how Social Security really works. We talk about what we call alternative investing. Those are using, in the financial industry, 4-letter words like life insurance and annuities.
I was going to say that there's a curse. At least the annuities are a curse word.
Oh,
I love
cash
annuities. Value
life insurance. Forget. Come in and I tell people you should have cash value life insurance. Life insurance is not an investment, and life insurance is a protection product. Buy term, invest the rest.
Right.
So yeah, I agree with the buy term. Everyone should have the bulk of your coverage should be term insurance.
Right.
You're not buying cash value life insurance for the protection. You're buying cash value life insurance for your retirement because it's tax free.
Yeah.
If it's done correctly. It's another problem with the insurance industry is it's not done correctly all the time.
As a real estate investor, we've been being told to buy high cash value policies. Avoid just up to the MEC. A MEC is when you have too much cash and it becomes a taxable event.
Yes.
Get right up to that threshold and be your own personal banker.
Be
your own bank.
Infinite banking.
Infinite banking. And I've looked at all the numbers. Now, for me, it's too late. At my age, it doesn't work. But my son's my business partner. He's 37. And we looked at the numbers and we found, I don't want to get to this here, but we found the break-even was too far down. So off camera, I want to talk to you about that.
Sure.
But we spent a lot of time looking at that. So
so they have this big thing in our industry called be your own bank.
Yeah.
Where you build up this cash value, you loan it to yourself, you pay back the loan, and when you need money again.
Right.
Because the interest that you're paying back in, if there is interest, doesn't have to be interest. Right. If there is interest, at least you're paying it back to yourself, so your account is going up. I can't tell you how much I despise that term.
Oh, okay.
Despise it.
So you were on the same page there.
Yes, despise infinite banking. The theory, it does work. But here's the problem with it, and I've seen it 1,000 times with clients. If I go out and take a car loan, what happens to my car if I don't pay the loan?
They repossess it.
They repossess the car. If I take out a loan from myself and I don't pay the loan, what happens to my car?
Nothing. You still have the car.
There's no consequence not paying back my loan. So everyone has the best intentions of, instead of taking out a loan to buy a car that I have to pay $500 a month for, I'll take out a loan for myself that I'll pay $500 a month for. And they do it until the first month that they're like, you know what, I'm a little short. I'm just going to skip that one.
Right.
There's no consequence.
Right.
And then that becomes the habit. And then 10 years later, they call us up and say, I don't understand what's going on with my life insurance. It tells me I owe X amount in interest. Well, yeah, you took out this loan and you didn't pay it back. So the interest builds up. And as the interest builds up, your death benefit goes down. You don't have to pay the interest, but now your $500,000 policy is worth $200,000. Right. And they say, well, that's not really fair. Well, you made the deal. I didn't make the deal. Right. So that's my problem with be your own bank.
Okay.
There's no consequence to the bank when you don't pay it back, and you're the bank.
Right. And you're the bank. Yes. Okay. So you believe annuities, the curse word, insurance? And I didn't think of insurance as a curse word, but apparently you know better than me.
Cash value.
When I'm talking
yes. Cash value life insurance as a retirement plan.
Yeah, I agree. Yes.
Life insurance retirement plans.
Yes.
We call them LIRPs.
Yep.
I go in a financial advisor's office and like, absolutely not. They're bad products. They're expensive. Their growth rates are slow. Yeah. Okay. Maybe some of those things are true. Some of them.
Yeah.
But they're tax free. So I can underperform you by 30% and still do better.
Right.
Because my net is going to be the same and it doesn't affect IRMAA.
Right.
Yours does. So, like again, for certain clients, it makes a lot of sense. For other clients, it's not a realistic possibility. Everyone should investigate it, though, to see if it's right for them. And no one does because they listen to the talking heads on MSNBC and the wirehouses. And no, it's not for you. Protection only.
Don't get me started on the MSNBC crowd and all those. Yeah. And I'm on the verge of getting started, so I'm going to stop. Go ahead. You keep going. I'm like about to explode, but go ahead.
We have a whole section called "The Kids Don't Want It" in the book.
Oh, the kids don't want it when it comes to Hummels and Yadros. What are you referring to?
We have a couple of things. The kids don't want your house.
Right. Yeah.
Don't leave that as an inheritance.
Right.
I have a whole thing in there about how the real estate bubble is coming, and it has nothing to do with overvalue or anything like that. It has to do with because the retiree population is not downsizing. If you look at the American housing cycle, you have your starter home, your forever home, your retirement home.
Right.
We've skipped that generation because of low interest rates.
Right.
People are not leaving their forever home. They're dying in their forever home, making it a true forever home.
Because the downsizing is more expensive now because the high rates.
Yeah,
well, the
property rates and the higher interest rates. People are saying, well, why would I leave Long Island to move to Florida and spend the same amount of money on a condo as I have on a 2,500 square foot house in Muttontown?
Right.
So they're staying.
Yeah.
And they're saying, you know what, I'm just going to leave the house to the kids. The problem is there are millions of retirees doing that.
Yes.
Tens of millions of retirees doing that. What's going to happen when all of them pass away?
As I said before, being a real estate investor, this comes up, I think, real estate pretty much 24/7, 23/7, because I'm talking to you for an hour. So, and I'm thinking about real estate. And people ask me all the time, do we have a real estate bubble? I said, there's no infrastructure problem like there was last time. The fog of mirror, get a mortgage, concept. And I was screaming from the rooftops. I was in the financial business. And I was telling my clients, this thing's going to implode. Let's put our money to a safer place. The world's going to go upside down when all these mortgages fail. It's going to affect the stock market, going to affect everything. And I played that very well. A little too early, I have to say. It took longer for it to happen than I thought. I also thought interest rates are going to go up long before they went up because they were down for so long. And that I missed by like 5 or 6 years. I was ahead of the curve in a bad way. But it wasn't unreasonable to think that. But I tell people there's no infrastructure problem, but it's not a government problem. It's not a tax problem. It's not an underwriting problem. It is a what's the word I'm looking for? A demographic problem. And I've never actually looked at that the demographics are going to change the market in that. Like right now, they're saying young people weren't buying houses, which is becoming a problem. Now those young people want houses suddenly. But you're saying that people are going to die with their forever houses, which can be there's a glut on the market of forever houses, which will bring prices down.
So think about young people aren't buying houses. Why aren't young people buying houses?
Well, now they can't afford them.
They can't afford them.
Right.
Why can't they afford them? There's no inventory. Because the people that got their starter homes can't move into forever homes because the people in the forever homes aren't moving to their downsize home.
Because the rate's so low.
We were looking for a house for 2.5 years. And it was every house we went to was a bidding war.
Right.
50,000 over, 100,000 over. It was like an auction, but not a good one.
Yeah, not a good.
It was like a reverse auction.
Right.
A reverse auction.
Yeah.
So what we're seeing is eventually that low inventory is going to explode because now the baby boomers are going to pass away. They're going to leave it to the kids.
Right.
The kids aren't going to need the house because they're going to have a house.
Right.
The kids are going to sell the house. But what's going to happen when the kid whose parents just passed away is selling a house on a block that's got 5 other houses for sale?
Right.
They're not going to have a bidding war.
So what they're going to do, they're going to call me, leave the key home buyers. We buy houses just like yours.
So they're either going to have to keep the house on the market for a really long time, pay the taxes, pay the maintenance until they get the offer they want, or they're going to have to sell it at a discount.
I just spoke to someone yesterday who lives in Binghamton, travels 2.5 hours to go to a suburb of Albany, because he can mow the lawn every 2 weeks on a house he inherited a year ago
Yeah.
and can't sell.
Yep. And that's going to, in my opinion,
Yeah.
I have no data to prove this.
Yes.
It's just me thinking,
Right.
reading the tea leaves. In the next 15 years, 10 to
Right.
15 years, that's going to be the problem. So I use another 4-letter word in the financial industry. Get a reverse mortgage.
Okay.
Consider a reverse mortgage.
Our last recording was a guy who sells reverse mortgages, who I thought were a terrible idea. And I told him when he walked in the door, we started the podcast, you got to sell me on this. And he sold me on it.
Yeah.
And when you look at it differently, I could see why a reverse mortgage makes sense. Also, the problem I have is reverse mortgages had a terrible reputation back when I was in the financial industry, and I wasn't allowed to talk about them. But I said, I don't care about the rules, and I spoke about them anyway. And it wasn't well. The fees were so high and everything else. The fees may be the same thing for all I know, but prices, what you're getting more money now. I don't know.
Yeah.
Whatever it is, they're still not cheap, but they're less unaffordable. But they serve a whole different purpose than I ever really thought. And he talked about his mother retiring. Her retirement income is from a reverse mortgage.
Yes.
And I thought that was fascinating. So you can
So
elaborate.
we talk about that as now I'm telling you your Social Security check is going to be much less than you anticipate.
Because of
It's
your
the
expenses
only
from-
guaranteed income you most likely have in retirement unless you have a pension,
Yep.
which are becoming more and more obsolete,
You have to be a government worker pretty much.
pretty much.
Yeah.
So what's something else you can do to recoup the costs of Medicare on a guaranteed basis every month? A reverse mortgage.
Yep.
And people don't want to do it because they say, well, now I can't leave the money to the kids or the house to the kids. The kids don't want the house.
They still get the burden
They have
of the house
option.
anyway.
Now they have the option
They
of
still-
the house.
They can still get it because
They can.
because they have to just pay off the mortgage.
That's right. Or
So-
they could just say, you know what? I don't really want the house.
Right.
Just give me the equity.
Right. That's what they want.
That's what they want. Again, it gets to the option. Don't
Right.
decide what they want. Give them the option. If they want your house, they'll just buy out the mortgage. They'll just remortgage it
Correct.
and take the house. But if they don't want it, they can walk away.
Right.
And now you've lived comfortably. Maybe that's what they want. Maybe they want their parents not to worry about how they're going to eat dinner. Maybe they want their parents to go to Florida when they want to go to Florida. Maybe they want their parents to go on a cruise when they want to go on a cruise. Maybe that's what they want. Maybe your kids are going to be just fine.
Right.
They don't want your house.
It'll be better than you think typically.
Yeah.
What I used to tell my clients was that, and I've said this in the podcast a couple of times, that inheritance is a consolation prize. I'm sorry, mom and dad are gone, but your consolation
Yeah.
prize is this inheritance. Whatever this is, it could be a big thing, it could be a little thing, whatever it is, that's their balance. Is it balanced? Of course not. But that's what you get. You lose mom and dad, but you get money. If their parents who have any money. It's not a requirement. It's not an obligation. It's just this consolation prize.
Yes.
And that's what I tell people. You have no reason. You've raised your kids. You've done it right, hopefully. They're on their own. And your parents didn't feel a need to leave you money. It wasn't that way. My parents' generation, again, I'm 68. My parents were born in the 20s. My mother in the 30s. No, sorry, Mom. She's not around anymore. But if she heard that, she'd be devastated. Anyway, you had to leave her retirement to the kids. That's the way it was. They got nothing from their parents. Their
Yep.
parents had nothing. They were European Jews from, Poland or whatever. And now, but they felt they had to leave me something. And I didn't want anything.
Yeah.
But they did. They lived well anyway, thank God. And I feel I have to leave my family something, in spite of the fact that I've been telling my clients for 30 years, don't worry about it. But I have a disabled granddaughter, and I'm worried about her.
Of
so
course.
if it weren't for that, I wouldn't want to feel any obligation.
I sell life insurance for a living, so
Yeah.
I'm big on leaving things to the next generation.
But
But
not-
that's what life insurance is for.
But also not at the cost of my
If it
lifestyle.
affects you, yes.
Correct. I shouldn't not go out to dinner because I want to make the
Absolutely
insurance
right.
premium payment. If I can afford insurance premium, fantastic. My father had oodles of life insurance. A second to die policies. For those, that means when my mother and father passed, it then paid off. It wasn't for either of their benefit. It was strictly for us. And by doing that, it allowed them to spend more of their money on their entertainment and fun and travel, which they did constantly, because they left us insurance money. And that was the consolation prize, was the big insurance policies. They had 4 or 5 of them.
So I see this all the time with clients. What's your financial goals? What are your objectives? And I want to leave $250,000 to each of my kids. I have 3 kids, so that's $750,000. I'm going to take it out of my money. That's their money. It's non-touchable.
Yes.
And I said, all right, well, I can almost guarantee you're going to need that money because everything you thought was going to happen in your retirement is off. All of your calculations are wrong. Yeah. So there's only one place for that money to come from. It's going to be from that $750,000. So you can either live a comfortable retirement or leave your kids $750,000. If you are so set on doing that, why don't we spread that $750,000 out over the next 25 years of your retirement by buying a second to die policy?
Right.
This way, you know they're going to get the $750,000, but instead of taking that off the table, you have to pay $10,000 a year for it. Again, not always a fit, but it makes more sense. The other thing I see people do all the time, getting back to kids don't want it, is people have old IRAs. From their first employer, I had $25,000. I threw it in this account. It's now $200,000. I forgot about it. Yep. It's obsolete.
Yes.
That's going to go to my kids. Do not do that. It's the worst thing you could do is pass qualified money on to the next generation.
Yeah, it's fully taxable. It's not the only
fully
no
taxable.
Step up. Yeah.
No step up. And even more so, most of the time when people are getting qualified money, they're at their highest earning years because they're in their 40s and 50s.
Right.
Now the government has changed the rules again with the Secure Act saying you can't stretch that money out over your lifetime. You have to take it out in 10 equal distributions over 10 years.
It used to be over your lifetime.
Yep.
Then it was over 10 years, however you wanted
it.
And now
just the principal.
Okay. Oh, just the principal.
Just the principal over 10 years, however you wanted it. Now it's 1/10 of the principal every year for 10 years. So now think about this.
Is the principal the amount you inherited then?
The amount you inherited. The gains supposedly are allowed to stay in.
Okay.
But now you have $1 million you leave behind. Well, I'm talking about, well-off people where they have $1 million sitting behind.
Well, $1 million is not well off, not here.
But I'm saying you have it set aside. That $1 million IRA, I don't need. That's for the kids.
Got it. Okay.
You have 2 kids.
Yeah.
Those 2 kids are now going to get $500,000 each.
Right.
That $50,000 now gets added to their taxable income every year. Maybe they're successful kids. Maybe that $50,000 puts them into that next bracket like we talked about. Yep. So now that amount of money, they're going to lose 30% on, 24% on, whatever it is. It doesn't only affect what they inherit. Now their wages go down because their effective tax rate has gone up.
Right.
So people say, well, what should I do? I say, well, you should inherit the burden now because you've created the burden.
Right.
Take the money out, throw it in non-qualified. Take the money out, put it into a SPIA, which is a single premium immediate annuity. If you want to leave that money to the kids and you're healthy enough, take it out, take the burden, take the tax burden because qualified money is fully taxable regardless of the annuity. But take that money out and whatever you net, buy a life insurance policy. Yep. It could be 80% of it. It could be 140% depending on your age or health, but it's 100% tax-free and the kids get it in a lump sum. So maybe they want it because they want to pay off their mortgage. So now if I just got $500,000 to pay off my mortgage, I'm going to get $250,000. Right. I've given up 50 cents on the dollar. Yep. But if I have a $450,000 life insurance policy, it affects nothing. That's all my money. I
was actually going to buy a second die policy and then I got cancer. So I have to wait my 5 years and so on, see what it looks like in 5 years. But I was talking about doing that with my wife, as I mentioned, because I was concerned about my granddaughter. So that's a good way to build money for the next generation, or maybe for my daughter to take care of my granddaughter. Don't do a second to die. You're gonna. Yeah. But on her, because sometimes I've had that where one spouse dragged it down. And generally speaking, she's gonna outlive you. Yes, because she's a female. Yeah, and she's also 2.5 years younger than me as well. Yeah. So that's interesting. So single life would be cheaper. It'll be cheaper because you're going to drag down that policy for the next 10, 15 years. Oh, for that, I didn't know that long. Yeah. Okay. So to give you, listen. So it's not so straightforward. I was in the business for a long time. I worked with my dad, and he did the life insurance. I did the investment side. So, so my life insurance knowledge is much greater than the average bear, but surely not as much as a guy who sells life insurance. Sure. So I didn't know that. I thought after 5 years I can get underwritten reasonably okay and so on, but you can get underwritten now, right? Because you're the second to die. They don't. Right. They're only insuring the healthier person. Correct. But it just would be a higher premium. But you're always going to drag that policy down. I did not know that. Yeah. Okay. So you learned something new. So these are the things that people like. You said something great. You know more than the average person about life insurance, but you don't know nearly as much as a life insurance person. At least a good one. That's what I feel about the financial community. Yes. They know more than the average person,
But it's shocking how little they actually know. And I'm not talking about all of them. That's a very generic term. I know
Yes.
tons of really, really good advisors that do the right thing by their clients, that give them all the information. They do the right thing.
Right.
Unfortunately, there's a large portion that don't. And I think I was telling you earlier when I was 24 or 25
Right.
when I started in the financial community.
Yeah.
I was given two pieces of advice: wear glasses and buy French cuff shirts because it'll make you look older.
Wear glasses.
Wear glasses and buy French
that'll
cuff
improve
shirts.
your skill set.
And because it made
French
sense. Like,
cuffs.
who's going to talk to a 24-year-old about their retirement?
Yeah.
So by the time I was 25, 26, I would sit down and I would have these conversations with people, and I had no idea what I was doing.
Yep. Yeah.
I passed the test. That's all I had to do was pass the test,
you
and I
have
got
the-
the card.
Do you have the readers like on the tip of your nose?
And the French cuff shirts and all. And I did everything they said. Buy another car because the Mitsubishi Galant's not going to impress
Right.
people when you pull up. So go in debt, buy a car because you're going to have a nice car when you pull up to somebody. Otherwise, no one's going to trust you. Dress well with a French cuff shirt, glasses, and have a nice pen. Okay, I could do those things.
Right. Right.
I still didn't know the difference between an annuity and an IRA for the first 3 years I was working. I thought they were the same thing. But I passed the test, and I was a financial advisor. And then I passed another test, and I was an investment advisor representative.
Right.
And I would show my card to people like, oh, this guy must know what he's talking about. I had no idea what I was talking about.
That's so funny. I love the French cuffs and the glasses. Don't get me started also on buying the car thing. I've issues about that. I'm a guy who drives a minivan for 10 years. So, but
smart.
anyway, so putting that aside. So let me ask you a sort of a lightning round of questions.
Sure.
All right. So what's the biggest insurance mistake people make when buying life insurance?
So there's a few. What we're talking about protection is no one buys permanent insurance.
Okay.
They only buy term. And then by the time that the term runs out, they can't get permanent insurance.
Correct.
So I'm a big proponent of small portions of permanent insurance, bulk term, and as you get older, convert it over.
Because the term will expire at the time you need it.
When you need it, 97.5% of term never pays a death benefit.
Now, keep that in mind, guys.
97.5% of term never pays a death benefit.
Term serves a purpose,
Term is wonderful.
but it's not your permanent life insurance. Don't mix them up. So what's the most expensive insurance mistake? This could be generic. A senior could make. That could be any kind of insurance.
A senior,
Yeah.
I get calls all the time of final expense insurance. Mm-hmm. That you see them all the time.
Yep.
For 10 cents a day, so you buy it per 1,000, you can go up to 25,000. But what they don't realize is it doesn't pay for the first 3 years. So people buy it for their parents when they go into a nursing home, thinking, well, at least the funeral is going to be paid for, not realizing that it's not going to be if they die in the first 3 years.
I didn't know that. But also, it's usually very expensive insurance per dollar.
Yeah.
People don't realize the cost is so low, but the benefit so low.
Yeah, it's
buy a life insurance policy because that's not term, that's permanent insurance.
It's permanent insurance.
Yeah.
So don't wait until you're in your 60s to get your permanent insurance.
That makes sense. Let's see. I have so many questions. I didn't know I wanted to go with my questions until we spoke further because I didn't know what the great American retirement myth really was about. What insurance should never be canceled without talking to an expert? So I see all the time.
Any cash value policy.
Okay.
People will surrender them and not realizing. So life insurance can be extremely tax efficient. It could also turn into a tax disaster if you don't do it correctly.
There you go.
So if you surrender it without talking to a professional, you can get hit with this massive, massive tax bill.
That's important.
Yes.
That's a huge one. Okay. Here's a big one. Does Medicare pay for long-term care?
No.
That's what people need to know.
Long-term care insurance covers days 91 and beyond.
Correct.
Medicaid and Medicare covers days 1 through 90.
Correct. So it covers the short-term care, not the
Correct.
long-term care.
Correct.
Which, that's why people are buying long-term care insurance, but it's become unaffordable.
So the biggest trend in the industry now is blended long-term care and life insurance. So you buy a life insurance policy that has a long-term care benefit.
Yep.
And you get, in generally speaking, depending on the product, the state, and all those things, you get 2% of your death benefit a month in long-term care benefits. The reason people like it is because you're guaranteed to get the money one way or the other. Either you pass away and your beneficiary gets the death benefit, or you go on claim and get the long-term care.
I have mixed feelings about that because people think they're buying it for the death benefit because they need it for whatever. Let's say if I die, I don't want to sell my wife the mortgage, won't have enough money to pay. Then I use the benefit for long-term care, and now I die. Now she can't pay off the mortgage and can't afford the house. And so I think people have to understand exactly what the product is.
It is, to a certain extent, that's true.
Yeah.
But then think about it this way. You've saved your assets, so now she gets the assets because you had to pay for the care one way or the other.
I'm not. It has value, but people have to understand.
They have to understand you don't get both. It's one or the other. So if you buy a $500,000 policy, you're getting $500,000.
Right, one way or another.
Either death benefit or long-term care. So if you use $250,000 of long-term care, you get $250,000 of death benefit.
Correct. Someone's getting that money.
Someone's getting the money.
You said you're getting the money. Someone's getting
Someone's
it.
getting
Right. It may not be you. I mean, they were called combination policies when they would. Maybe the last years I was in the business, they just started, and they were new and they weren't very good. They've morphed, I'm sure, over this time.
The Lincoln Money Guard back then is probably that was like one of the first ones.
Yeah.
Now those were long-term care policies with a small death benefit.
Right.
Then they've changed into life insurance policies that give long-term care.
Give long-term care, right? If someone can't qualify for long-term care insurance, what options do they have? I don't know of any.
Depending on the state, you can buy an annuity with a long-term care rider. Most of them are not medically underwritten.
Right.
So we just did one, and this wasn't because of a medical issue. A woman in Arizona, she purchased an annuity, and it was an income annuity. So she was getting, $5,000 a month or whatever the number was.
Income annuity, you give the insurance company a chunk of cash, and they basically give you a pension for the rest of your life.
Correct.
So instead of working to get the pension, you're buying a pension.
It's a privatized pension. So you're going to give it to them, and then they're going to give you money for the rest of your life. She was able to add a long-term care rider on it where if she goes on claim for 5 years, her $5,000 a month turns into $10,000 a month.
Oh, that's interesting. I never heard of that.
Yeah, so it's not...
It's not in New York.
Not for everybody because you need a chunk of change to start it, and it's definitely not in New York. I get into New York in the book, and why this state
terrible.
is just...
It's terrible. It's available in 49 states. It's usually New York's the one, the outlier. Pretty much almost always.
And do you know why that is?
No.
Because of Wall Street. They won't
really?
say it.
Huh. Well, Wall Street's leaving New York.
They're going I say it all the time. They're going to Dallas.
They're going thanks to Mandami. Maybe we'll start getting better insurance products.
I tell everyone, buy real estate in Dallas right now because in the next 10 years, that's going to be the financial hub of the country.
Absolutely. So question, what's the average cost for long-term care? Not the policy, but for long-term care today. Let's talk here in the Northeast.
What's the average cost for the care itself?
Care itself.
For a good nursing home, above average nursing home, you're $12,000 to $14,000 a month.
Yeah.
For an average nursing home, you're $10,000 to $12,000.
Right.
In-home care, which most people want, you're probably around $7,000 to $8,000.
It's in-home care because we have that for our family, and it's right now $37 an hour.
Yeah.
If you're not getting 24-hour care, if you're getting 24-hour care, it changes, but it's $37 an hour.
Yep.
For a 10-hour day, it's $270 a day for a 10-hour day. That's a lot of money.
Yeah.
That's the beauty of long-term care insurance. Problem is, it's hard to get, and it's unaffordable.
I tell everyone, so I sell a good amount of long-term care.
Standalone
long-term care. I sell a good amount of it.
Okay.
And people say, what do you think about this? And I said, this is either going to be the best thing you've ever purchased or the absolute worst. There is no middle ground.
Right. And people would complain that if they don't use it. I said, but you don't want to get into a car accident because you have auto insurance. You don't want your house to burn down because you have homeowners insurance. This is even worse. You don't want to need care because you pay for this. The difference is this costs so much money that you still don't want to return, but you feel like you want to return. You're not spending $2,000 a year on this.
Yeah.
What's your average long-term care premium these
For
days?
a decent policy in New York for a husband and wife, you're in the $15,000 range.
That's about what we're paying now.
Right where people are buying it in their mid-60s. You're around $15,000. That's a good policy. Not great.
Right.
You're going to be out of pocket a little bit.
Right.
But you're not overinsured.
I'm paying $16,000. I'm 68. I bought my policy when I was 45.
Yeah.
I was paying $4,000. It's now $16,000. But I have about an $850 a day policy. So my
Huge
next
benefit.
my next price increase, premium increase, I'm going to reduce
Just going to reduce your benefit.
Yeah.
Yeah, I'm talking what we're selling a lot of is $300 a day, no inflation, or $250 a day with inflation.
My policy was if you were 70 to 74, 5% simple inflation meant your daily benefit went up by 5% a year. And if you were under 70, I did 5% compound inflation. I think that's self-explanatory.
Yeah.
That was sort of my rule of thumb. And over 75 or older, you don't need inflation.
You have a huge, that's why it's so expensive. It's such a huge benefit.
Yeah.
If you look at it, a lot of the time, the annual premium will be very, very close to what the monthly benefit is.
That's interesting.
So if you pay for it for 20 years, you have to go on claim for 20 months to break even.
The break even is so little. I mean, 20 months of claim is a short claim for long-term
If
care.
you're in-home, and most people are buying it for in-home,
Right.
you're going to outlive your break even. If you go to a nursing home,
Right. You use the money very fast.
you use the money very fast, and let's call it the stay in a nursing home is much, much less.
Yeah. Oh, shorter. Correct.
Yes.
And most people start at home and move to nursing home.
Correct.
Most people don't go from home to nursing home unless they're coming from a hospital.
Yeah.
Something happened.
Unless it was an injury or
A
an
stroke,
illness that they got
something.
over.
Correct. But if you're just aging, you age at home first, needing care, and then you move to a nursing home. Maybe even assisted living possibly, then nursing possibly, but usually it's
Yeah,
to a
and
nursing
assisted
home.
living is covered. The
Right.
other thing that's covered is hospice.
Yes. Yes. But that's definitely short term.
Short term. But
Yes.
again, that's a lead in where you go from one to the other and then you
Right.
end in hospice, unfortunately.
Yep, absolutely. How old? What's the oldest? This is a generic. This question is a generic, obviously. Should a 70 or an 80-year-old still consider buying life insurance?
Depending on their goals and obviously their health, maybe. If they're wealthy and they want to leave tax efficient money behind and they can get it underwritten, there's no reason not to.
Don't think the insurance company is using statistical data to write you,
They're not going to lose money.
and so the question is: are those statistics working enough in your favor? They're always in the insurance company's favor, but enough for you that it makes it work.
So I'll tell you what makes it more feasible that it can help you is you have to put, whenever somebody buys a life insurance policy, the insurance company has to put a certain amount of money in reserves.
Yep.
Those reserves are getting insane interest amounts, something that the retail investor would never even sniff. So it's not only the premium that's making you money, it's now they are able to put more money in their reserve requirement. They're going to make money. They know what your life expectancy is. If you die a couple of years before, they might lose a little bit of money. But if you die at or after, they're making money.
Right.
And your life expectancy is never your break even.
Right.
Your break even usually is until around 110.
Oh, really?
Yeah.
Well, that's it. I did not know that. That's chance of making it to 110 are pretty slim.
You
Pretty
you
slim.
could only hope.
You can only hope they're pretty slim. I don't want to be 110.
No, I don't want to. I would agree with you.
No. What happens if someone outlives their retirement savings? Besides moving in with the kids, I mean, there's no good answer to this one.
No, that's it.
There's no good cardboard box for the children.
I'll tell you what you're not going to do.
Yeah.
You're not going to get a phone call from the financial advisor or the accountant that helped you get there.
Right. You're not going to get a call
That's
from
not what
that.
you're going to get.
You stopped speaking to him a long time ago.
Yeah.
You stopped to him a long time ago. Okay, here's one. And you don't have to answer because you've answered. Are annuities really as bad as some people claim? And you're an annuity lover, but we said something early on before the camera started rolling about annuities.
Yeah, so annuities have a bad rap. And I get into this in the book also about the truth behind annuities. There are three major things that people, four things that people knock annuities for. The first is expensive. The second is the commission. The third is the performance. And the fourth is illiquidity.
Expensive means annual expenses.
Annual expenses.
Right.
inside of
Commissions are obvious, and the other. Go ahead.
them. Illiquidity and performance.
Yep. Liquidity because you have surrender charge. Your money's tied up.
So
And performance because of the expenses.
you'll do better. You'll do better by investing your money.
Right.
So let's start with illiquidity. That's easy. That's true. There is no illiquidity in annuity. Yeah. It's not a liquid product. I'm sorry, there is only illiquidity in annuity. It's not a liquid product. It's not something that you can tap into when you need money. So if you need liquid money, don't go to anywhere near an annuity. Expenses. Annuities are as expensive as you want them to be. Variable annuities tend to be expensive because there are a lot of fees inside it. There's mutual fund fees, the same mutual fund fees you would pay if you bought a mutual fund.
Correct.
But there's a death benefit to an annuity
Which
that
you
a
don't
mutual
have
fund doesn't have.
Exactly.
That's called an M&E fee, a mortality and expense fee. So if your portfolio inside of the variable annuity goes down and you die, most of the time your family will at least get back what you put into it. That's what you're paying for. Then you can add riders to it. Guaranteed income riders, guaranteed growth riders. You can do these things. Each one of those come with a fee.
Yep.
If you don't want to pay those fees, don't get the riders. Don't buy a variable annuity.
Yep.
Other annuities are free. SPIAs, single premium immediate annuities. I give the insurance company money. They guarantee me lifetime income. That's a net number.
Right.
There's no fee. They don't say, well, I'm going to give you 1,000, but there's a 1% fee. You're only going to get 990. They give me the full 1,000. Fixed index annuities, generally speaking, have zero fees. Whatever the index does is what you get. If it does 10, you net 10.
Usually it's just a cap.
There's a cap, there's a participation rate. I
Right.
go through all that in the book because it's.
Yes.
I think that's where I fell asleep writing it. It's a lot. They're nuanced, but you have to find an advisor that knows the way all of them work.
I remember this particular Equitable had come out with a new product and I got we're big annuity sellers. I love the annuities for the right people. I said the best product for the right people, the worst product for the wrong people.
Mm-hmm.
That's my philosophy. And we're big death benefit, income benefit people, and so on. So, long out of that business. But so Equitable comes out with a product. They know we're big players in the annuity business, and the rep comes personally on Thursday at 5:00, and maybe 3:00 at the end of the day, and hands me 2 copies of the new material. He goes, but you can't show it to anyone. It's not going live in New York until Monday, but I'm giving it to you so you can review it. So I commuted to Manhattan. I go home. I'm looking at it with my father. He's looking at his. I'm looking at mine. We come up with all these questions. I call on Friday with a bunch of questions. They have a hotline. Just answer questions on this new product. And I ask a question, she doesn't know the answer, I'll get back to you. She gets back to me, ask another question, she doesn't know the answer. These people are trained specifically to answer questions on this new product. I then call Monday. I ask 2 more questions, they don't know. I call Monday afternoon, ask a 3rd question, they didn't know. 5 questions, everyone they had to research and get back to me. These are people, there's only 4 or 5 people in this group who were trained just for this. And on Tuesday, they had a meeting and had the lunch go on Monday. And they said, one guy said, this guy Larry Wagner keeps calling me and he's asking questions. I don't know the answer to any. He called me too. Because I kept different people. And they said, so my rep said, you're the only person that asked them a question that stumped them. The only one.
You were the test case.
Right. I asked 5 questions. I stumped them 5 times. Not one of the rep called them with a question they didn't know the answer to, because people just look at the pretty stuff and the graphs. They don't read the prospectus. They don't read the details. And the devil is in the details.
So they gave it to you because the internals are not retail salespeople. They're wholesale people. They knew that if they gave it to you, you would ask the questions that they're going to get. That's why they gave it to you early. You were the soft opening.
I never thought about that.
You were the soft opening on that product.
They used me.
Yeah, they did. You should have charged them a fee.
I should have charged them a fee. But 5 out of 5 questions they did not train their people on.
But now they had those, and now they know how to answer them if anybody else asks.
But it was so fun. I spoke to 3 people. I spoke to that. It was very funny. And this story goes back a couple of decades. I remember like it was yesterday. Anyway, so back to questions, annuity.
So they're illiquid.
Yes.
They could be expensive. They could be much, much cheaper than any investment you buy. Mm-hmm. You put money in managed money, it's 1%, generally speaking. That 1% comes out like clockwork every year, every month, whatever it's broken down to. Yeah. It could be way more than any annuity you're ever going to pay a fee on. Performance. Generally speaking, will the market outperform an annuity? Probably. But it's all about timing.
Yep.
In your annuity, you're not going to lose 40% the year before you retire.
Right.
In the market, you can.
Yep.
So you're giving up a little bit for the protection. If that's for you, then do it. If it's not, don't. My rule of thumb is never more than 30% of your portfolio in an annuity.
Okay.
General rule of thumb.
You're raising a lot of anger on that comment, I'm sure.
Yeah. Like there are some people that you can go up to 50 because they have a pension or they have other things or they have no, the house is paid off. They don't need things. Right. Generally speaking, I don't like to go more than 30%.
Right. But people don't like annuities at all, and you're even saying 30%.
Oh, they're pulling their hair out.
Yeah, absolutely. Smoke's coming out of their ears.
So that's the way you get around the performance is it's only a portion of your money. It's the same as going 60-40 in a stock bond portfolio.
Okay. So let me see a question about annuities. The difference between a mutual fund and annuity, mutual fund has a step up in basis. So when someone inherits you buy a mutual fund for $10, let's say $100,000, it's now worth $180 when you die. The kids sell it, they pay no tax. But if you sell it, you pay tax on the $80,000.
Yes.
But if I buy a $100,000 annuity, it grows to 180, and my kids inherit it, they still pay tax on the 80.
On the non-qualified side, yes.
On the
It
non-qualified
does not
side.
get the step up in basis, but
Right.
you can do a non-qualified stretch on that 80,000.
Okay.
It doesn't have the same rules as qualified
So
money.
you can take the money out over your over
You
a
can
long
take the
period of time.
100,000 cost basis, and then
Yes.
the other 80 you can spread out over your life.
Oh, so you can still take the principal out first?
Yeah, usually you can do a withdrawal and then a spread.
Okay.
If it's qualified money, it doesn't make a difference either
no,
way.
that's taxable.
So I say all the time, again, everything's different.
Yep.
Generally speaking, usually use annuities for qualified
Me
money
too.
because there's the exact same tax code. Everyone, the other thing, they're not tax efficient. Yeah, non-qualified annuity does get taxed differently because it's ordinary income tax
Right.
versus capital gains, even though it's a non-qualified account. But as we discussed earlier, for certain people, some people, capital gains tax could be higher than your effective tax rate. So it could be tax effective. You don't know.
Yep.
You have no idea what your tax rate's going to be versus your
Correct.
your capital gains tax.
That's very true.
The commissions is the thing that gets me though. That's the biggest
Yes. Oh,
knock.
yes, you talked about
Biggest knock on annuities is the person's only selling it because it's got big commissions.
Yeah.
Most annuities, variable annuities, fixed index annuities pay pretty big commissions. The fixed annuities, multi-year guaranteed annuities, deferred income annuities, SPIAs, they don't pay really large commissions. But somebody who focuses on managed money will say, I only get paid 1%. They're going to get paid 7%
Right.
for the same amount of money. And then the clients go, they're just taking advantage. I mean, they're just doing it for the commission. But here's what I tell people. When you go into managed money and you're getting charged 1% for the advisor to manage the account every single year, you pay that 1% every single year. I'm not even going to say after 7 years you're losing money. You're losing money in day one because you pay the advisor the 1%. If you have $1 million,
Yep.
1% of that goes to them. So you start with $990,000. If I get paid 7% on an annuity
Right.
and you give me $1 million, I make $70,000. Your account balance is $1 million. You don't pay the commission, the insurance company does. So do you really care how much money I make if you don't pay it in comparative to how little he makes if you do pay it?
Right.
So that's the question I ask people. That's why I think the commission argument makes no sense.
Okay. It makes sense. That makes sense. That makes sense. Very interesting. You said that before, and I thought it was a very, very interesting way of putting it.
Now, granted, there are way too many insurance people that sell the annuity strictly for the commission.
Oh, absolutely.
I've come into it numerous times, had a conversation with a woman where 94% of her assets were in an annuity and she needs more money and she can't touch it. And I said, you need to file a complaint right now with FINRA, with the broker that sold it and their company, because
Right.
that shouldn't have happened. That should have never gotten through compliance.
Right. Right. Yep. We see a lot of it all the time. Okay. So if there's one big takeaway you want for this podcast, I can talk to you for another hour without batting an eye.
Yeah.
I have so many questions still here I'd want to address, but I usually try to keep these an hour. We'll probably 10
Sure.
minutes past already. What is the biggest takeaway or biggest takeaways that you'd want to reiterate? quickly?
Retirement is not a cookie cutter plan. Everyone is different. Do not follow the same advice that your parents and grandparents and friends and cousins and uncles follow. Ask questions. Figure out what works best for you. Think about how you want to be taxed. Think about how you want to receive your income. If your advisor doesn't know how to answer the question or won't answer the question, find a new advisor. They're all over and they are wonderful. It's not cookie cutter. Drives me crazy.
Very, very well said. So, Jim, I thank you. You have your book coming out, The Great American Retirement Myth.
Yep.
I got that right. And so people can reach you through that name. How do people reach you?
The book website is retirementmythbook.com. My email address is jim@theintegritylb.com. So the Integrity Life Brokerage. So theintegritylb.com. And my website's theintegritylb.com.
Okay, perfect. I thank you very much for coming. This was
Thank
a
you. This was
fascinating
great.
discussion.
I appreciate it.
Very good. Thanks for listening to this episode of the Unlocking Senior Resources podcast by Leave the Key. If you've enjoyed this episode or found it helpful, don't forget to subscribe, leave a review, and share this podcast. We specialize in working with seniors who are transitioning out of their homes, and we understand what you are going through. So if you are considering selling your home and would like an alternative to the traditional overwhelming process, reach out to see how we can help. When working with us, you can sell your home in its current condition, there is no need to remove unwanted items, and you control when the house is sold, along with so many other advantages. Visit leavethekey.com or call us at 631-388-7771 to learn more about our senior home buying process.